And welcome back to the Lance Roberts Show podcast right here at Lance Roberts Show. Also at our YouTube channel, The Lance Roberts Show. We're talking today with David Zugheri from Morgan Rockwood, private lender, about real estate. And as we were talking about just before the break, we have seen here in the last really year or so, starting to see Fannie Mae, Freddie Mac kind of relax some of the standards in terms of getting people into mortgages, 3% down payments, reducing requirements for credit applications, etc. We're actually seeing a movement now to try to come up with a new standard rather than FICO score that will allow more people to fit in with the credit-worthy status. Are we starting to make some of the same mistakes that we made pre-2008 in the current environment, trying to get more credit to more people?
Sure, and it's much needed, Lance, because just like you say, use the analogy of a rubber band. You pull too far back and then it swings too far the other way. Right. And Dodd-Frank was just way too restrictive, and you can see it in the Houston housing numbers. From December 2017 to December 2018, the market from 100,000 to 150,000, which used to be the sweet spot in Houston, was down 27.5%. Let's go up 150 to 250,000. That segment of the market was down almost 2%. Right. So who's being impacted by the regulation, the Dodd-Frank ability to repay and all these other provisions that are in there? Right. In Houston, for example, and I would bet you dollars to donuts in other major metropolitan areas, the numbers look the same, right, but in Houston, it's 250,000 and below. Right. Okay, so who's being damaged? It's the common folk. Right, right. It's not the wealthy people. Right. The market in Houston from 750 to above, 750 and above, December 2017 to December 2018, increased by 20%. So the rich get richer and the poor get poorer, predominantly in this case driven by the credit markets. Okay. So the government looks at that, Fannie Mae, Freddie Mac, and also FHA, they look at that and they say, well, how can we fix this? Well, we have to expand a little bit. Right. Well, what do we need to do? We need less down payment. We need to expand on our credit scores. We need to expand on our ability to repay, which is your debt to income ratio. We need to expand on all these things. Why? To drive that segment of the market. Right. Dodd-Frank has shot a cannon through low to moderate income folks, through that segment of the market. So people will say, well, we're starting to get back into subprime, and we're starting to, oh my God, here we go again. No, all that we're doing is we're just easing a little, we're just turning that knob a little bit to see if those loans perform. And if they perform, what will happen? Turn it a little bit more. And if they perform, a little bit more. But I'll tell you, Lance, it's not designed for the 750,000 and above buyer. Right. They're really targeting that 250 right, and less, which is a good thing. Right.
Well, no, look, and I don't have a problem with extending credit to individuals. And again, but when we talk about credit responsibility, right? So. Sure. We step back and yes, we have this desire. Of course, the banks and lenders, they want to be able to lend more credit because that's how they make money. Absolutely. But there's also a moral hazard to this as well. I mean, if we take a look at the financial statistics of the average American across this country, right? They're living paycheck to paycheck. They don't have the ability to service the debt they have, and small changes in interest rates. Even very small changes in interest rates. You go from 3% to 4% on a mortgage rate, all of a sudden we see mortgage applications drop sharply. People can't afford the payment. So, while yes, there is a desire and a need to try to help foster this market by giving people cheaper and cheaper access to credit, there is also a moral hazard to that as well, from the standpoint that we are continuing to erode the financial stability of America as a whole, right?
Sure. And keep in mind that when you talk about Fannie Mae, Freddie Mac, and FHA, when these loans go bad, who's on the hook?
Yeah.
It's the taxpayer.
Sure.
So there was once an implied government guarantee.
It's now implicit.
After the credit crunch, it was explicit. It happens. Yeah. The government will back these. And it's already been tested. So you sit there and you go, so I'm going to make a riskier loan to somebody, and me being a lender. And ultimately, that's going to fall on the U.S. government to make that right if they go bad en masse. Right. And I would say, yes, that is what's happening now, but I would also caution that with, hey, look, we're just in the beginning stages of turning that dial. Right. And it's not like there's $1 trillion of bad loans waiting to happen. This is nothing like the credit crunch where we were not verifying income, assets, credit, everything went out the window. Down payment, what's that? Why do you need it? You know,
Yeah,
and
but those were good times, though. If you're in the mortgage industry.
If you were in the mortgage business and you were taking the loan and selling it and passing the risk, yes, they were good times. But the chickens came home to roost, and it drove a lot of people out of business.
Right.
That's not happening now. But we are in the beginning stages of loosening up.
Right.
Now, will we know when we get too far? I don't know.
We didn't know before.
We knew before.
Well, so let's change the angle here a little bit, though, because we have seen a real trend change following, and particularly in that area of the market you're talking about, that 150 to 250 bracket, maybe 350 even. We saw a real change coming out of the financial crisis, which really wasn't individuals buying homes. We saw a big change to where institutions were coming in and buying, you know, hundreds and hundreds of these homes within this lower end of the range and turning them into rental properties. And in fact, if we take a look at the Census Bureau statistics, you know, home ownership in the country is back to levels that we haven't seen since the late 70s. But
on the low side.
On the
low side.
But on the rental side, we've got the number of people renting homes at all-time highs. And of course, we've also seen a big explosion in multifamily builds, et cetera. Just from a cycle standpoint, I guess this is one of the questions to be thinking about, are we building up an excess of this multifamily rental type property? And what happens if there's a change to where people want to exit this market?
When it comes to multifamily, and I've been an investor in several multifamily projects, as we discussed before the show, it's definitely hot. And there has definitely been a lot of, believe it or not, Fannie Mae and Freddie Mac, they also finance multifamily.
Sure.
So those numbers, when it comes to lending, are sky high. So you're right, post-credit crunch, there were a lot of folks that were just, credit was not made available to them.
Right.
And so where do they go? They have to go somewhere. They're going to rent an apartment or they're going to rent a house.
Right.
Those are the only two options. That being said, has that market heated up? And I think that's been played out. I think the idea of an institution coming in, and I know several hedge funds that went and bought in the thousands of houses just in the city of Houston and like Dallas. I mean, very concentrated areas, big numbers. And let me tell you their rates of return. One guy, he told me his rate of return on like 3,400 houses, less than 6%. Think about it.
Right.
3,400 houses, and they're managing them themselves.
Right.
I would rather, we're not high enough in this building for me to jump out of the window before I would want to manage 3,400 houses.
Right.
It is just, and I think, and the reason why I was having conversations with this one particular hedge fund is he's like, do you want to buy some of these houses?
Right.
And I was like, no.
Well, that's my question is that it wasn't just this hedge fund. We saw BlackRock. We saw we saw very, very large hedge funds get into this market of buying these rentals. And the question has always been, when rates start to come up, which that's happening, and your capitalization rates start to come down, your returns come down. What happens when you start seeing these hedge funds, et cetera, wanting to exit this market at a time when, again, going back to our conversation earlier, a lot of people simply can't qualify to buy a house.
Yeah.
Who are you going to sell to?
That's going to be interesting, and whether or not there's enough inventory there to swing the market, that's questionable. I mean, in the city of Houston, Lance, we last year we sold 82,000 homes, single-family residences, and I go, this hedge fund may have 1,000, 1,500. So if they put them all on the market at the same time, could that move the needle? I think who they're going to sell them to? I think they're going to sell them to other people trying to make money as landlords.
Right.
Suckers.
We'll be right back after this break on the Lance Roberts Show podcast with David Zugheri for Morgan Rockwood. Don't go away.
You can get daily real investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at realinvestmentadvice.com.